Casinos never actually know the outcome of the next blackjack hand. They do not know if the next card out of the shoe is going to be a king, a three, or an ace. They do not know if the roulette ball will land on red, or black, or bounce out of the wheel entirely and hit a drunk tourist in the eye. They operate in a state of absolute, unapologetic mathematical uncertainty on a minute-to-minute basis. Every single event happening on the casino floor is entirely random. Yet, the owners of these casinos sleep like babies on $1,000 silk sheets. They do not sweat. They do not panic when a high roller wins 10 hands in a row. They know with absolute, unquestionable certainty that by the end of the year, they will have made billions of dollars. Meanwhile, you are sitting in a dark room at 3 in the morning, staring at a 1-minute chart. You have the heart rate of a hummingbird on espresso. You are sweating through your shirt, desperately looking for a 100% guarantee on an entirely meaningless trade. You think you are losing money because you lack discipline. You think you just need a slightly better strategy, or a faster internet connection, or a magical indicator that turns green right before the price goes up. You are entirely wrong. The real problem is biological. Your brain is a highly advanced survival machine built over millions of years by evolution. If our ancient ancestors walking through the savannah heard a sudden rustle in the tall grass, they had to be absolutely certain it was just the wind, or they had to run for their lives immediately. The humans who enjoyed uncertainty, who liked to wait and see if maybe the rustling grass was a friendly animal carrying snacks, got eaten by tigers. You are the direct descendant of the highly anxious people who demanded certainty. In nature, certainty equals survival. But financial markets do not care about your survival. Markets operate strictly on probabilities, statistical variance, and complete randomness. When you try to force certainty into a completely random environment, you do strange, destructive things. You wait for absolutely perfect setups that do not exist. You cut your winning trades early just to secure a tiny, irrelevant gain. You hold onto your massive losing trades for weeks, praying they return to your entry price so you do not have to admit you were wrong. You are not stupid. You are acting completely rationally based on how your biological hardware is wired. You are just operating in the wrong universe. Your psychological need to feel safe is mathematically destroying your edge. It is a brilliant biological adaptation. It is a terrible trading strategy. You probably think the secret to making money in the markets is finding a system that rarely loses. This is the first trap. Traders who obsess over certainty naturally gravitate towards strategies that promise an 80 or 90% win rate. They buy courses from guys on the internet who never seem to have a red day. The math feels fantastic at first. You take a trade, you make a little bit of money, you get a massive hit of dopamine, and you feel like a genius. You win 10 trades in a row. You start doing the math on a napkin about how long it will take to buy a private island. But mathematically, systems with massive win rates almost always require terrible structural foundations. To win that often, you have to take profits the second they appear on the screen, and you have to use a massive stop loss to give the trade enough room to breathe. You are risking $100 just to make $5. You spend weeks carefully picking up pennies off the train tracks. You feel incredibly successful and perfectly safe. Then one day, you do not hear the whistle blowing. The train hits you. One normal, statistically inevitable losing trade wipes out 20 beautiful, hard-fought wins. You are not trading. You are renting profits from the market until it decides to collect its debt with interest. If an 80% win rate is the ultimate goal, why do the most profitable, multi-billion-dollar trend-following hedge funds in the world operate closer to a 40% win rate? They lose more than half the time. They are constantly wrong, but they simply do not care, because when they are wrong, they lose a tiny fraction of a percent. When they are right, they ride the trend for months. They accepted uncertainty. You demanded a guarantee. I do not say this to be philosophical. I say this because I have seen the raw numbers. When I worked as a data analyst for a major prop firm, I had unrestricted access to the back-end servers. I spent months analyzing the raw, unfiltered trading history of thousands of funded traders. I wanted to find the exact mathematical difference between the 1% who receive massive payouts and the 99% who quietly blow their accounts. I took that classified data and put it into a book. It strips away the internet myths and hands you the reality. First, you get the unrestricted server data. I show you the exact metrics of the top 4,000 traders, how many pairs they actually trade, their true win rates, their actual risk-to-reward models, and their precise daily loss limits. Second, the book gives you the mechanical rules these elite traders use to physically force patience, brutally stop overtrading, and silence their biology. Finally, it gives you the exact mindset shifts required to survive massive drawdowns without having a mental breakdown. Stop guessing what profitable trading looks like. Read the data. The link to grab the book is in the description. Waiting for a trade to look completely safe is the most expensive habit in trading. You know the exact feeling. You see a setup forming, but you are scared. You do not want to be wrong, so you wait. You wait for the moving average to cross. Then you wait for the relative strength index to drop into the oversold zone. Then you wait for a massive green candle to close firmly on the hourly chart. Then you check the economic news calendar to make sure the global economy is not actively collapsing. By the time all 5 of your specific conditions are met, the trend is painfully obvious to every single person on Earth. The trade finally feels safe. The anxiety leaves your body. You smile, you hit the buy button, and you relax. The market instantly turns around and crashes. You sit there in stunned silence, wondering how the universe knew exactly when you entered. The universe did not know. The financial institutions knew. Certainty is fully priced into the market. Risk and reward are tied together by heavy, invisible chains. Large financial institutions make their billions by buying when things look terrifying, chaotic, and completely uncertain, because that is when prices are cheap. They ride the price all the way up. Eventually, they have massive profits, which means they need to find a buyer to unload their positions onto. They patiently wait until the chart looks absolutely perfect. They wait until every technical indicator is flashing green. They wait until you feel perfectly safe to buy. Then they sell their risk directly to you. You are paying a massive premium in the form of a terrible entry price just to buy a temporary feeling of emotional safety. You literally cannot make large returns on comfortable, obvious ideas. If it feels good, you are already late. Are you consistently buying at the exact top of the market just because you refuse to execute a trade without a written permission slip from the universe? Moving your stop loss to break even is killing your biggest trades. This is a behavior every beginner does, and they do it proudly. You enter a trade, and it immediately goes slightly in your favor. Your heart starts beating a little slower. But then the fear creeps in. What if it reverses? What if this green number on your screen turns red? So you do what feels incredibly responsible. You drag your stop-loss line right up to your entry price. You sit back in your chair, take a deep breath, and tell yourself you are a master of risk management. It is a risk-free trade now. You cannot be hurt. You are trying to manufacture certainty out of thin air. You want the relief of knowing nobody can touch your account today. But markets breathe. They go up, they pull back, they gather liquidity, and they go up again. That is the normal, messy mechanics of price delivery. By moving your stop to your entry price too early, you mathematically choke the trade. You leave absolutely no room for normal market noise. The price drops back down, taps your exact entry line, triggers your stop, and kicks you out of the trade for zero profit. Then, precisely 5 minutes later, it rockets upward to your original target. You stare at the screen, furious. You blame market manipulation. You blame your broker. But it was not manipulation. You strangled the trade to protect your feelings. How much total profit have you sacrificed this year just to avoid the temporary ego bruise of a small, mathematically planned loss? You protected your pride flawlessly. Your account bled out. Looking at more charts does not make you a better trader. It makes you a paralyzed one. Because we hate uncertainty, we falsely believe that gathering more data will eventually cure it. We think if we just add one more analytical tool, we will finally crack the code and see the future. So you add order flow footprints to your screen. You add level 2 data. You stack 5 different moving averages on top of your candlesticks. You start tracking the correlation between gold, the dollar, the Japanese yen, and the price of oil. Your computer monitor looks like a NASA control room during a critical moon landing. Your family walks past your bedroom and thinks you are a financial genius. You are actually just incredibly confused. Instead of giving you clarity, this mountain of data just creates conflicting signals. The 15-minute chart says the market is going up. The 4-hour chart says the market is crashing. The order flow shows big buyers, but the news just announced terrible inflation data. Your brain completely freezes. You sit there watching absolutely perfect setups pass you by because your indicators are endlessly arguing with each other. The market is entirely random on a micro level. More information cannot predict a random event. Flipping a coin in a brightly lit room with 10 high-speed cameras analyzing the wind resistance does not change the fact that it is still just a coin flip. The extra data just gives you a false sense of control over something you cannot control. If having more information actually led to better trading, wouldn't university economics professors be the richest day traders on earth? Instead, they drive used sedans. You are not one magic strategy away from being profitable. Every new trader goes through the exact same exhausting cycle. You find a shiny new strategy on the internet. You test it for 3 days. You make a little money. You decide this is it. You have found the golden ticket, and you are going to be rich. Then you take a loss. It hurts a little, but you accept it. The next day, you take another loss. Now you are worried. The third day, you take a third loss in a row. Your biological alarm starts screaming. This strategy is completely broken. The market has changed. The person who taught you this is a fraud. You immediately abandon the system, open a new tab, and start searching for a new strategy that actually works. You do this for years. You build a massive graveyard of discarded indicators, trading plans, and broken dreams. You are doing this because 3 losses in a row violently threaten your desperate need for certainty. You secretly believe that a truly good strategy simply should not lose. But you are confusing a failed system with perfectly normal statistical variance. Even a strategy that wins 60% of the time will regularly have streaks of 4, 5, or 6 losses in a row. It is mathematical law. If you flip a weighted coin that magically lands on heads 60% of the time, you will still occasionally get 5 tails in a row. The coin is not broken. Your strategy was not broken. Your patience was broken. Is your trading strategy actually failing, or is it just a perfectly normal statistical model going through a standard variance cycle that you violently refuse to accept? Closing a winning trade early feels amazing today, but it mathematically guarantees you will go broke tomorrow. You enter a trade based on your plan. Your target is $100, and your stop loss is set at $30. Everything is aligned. The trade starts moving in your favor. You are up $40, then $50. Suddenly the price slows down. A tiny red candle appears on the screen. Your heart rate jumps. You start doing mental gymnastics. You think about how you could use that $50 to buy lunch today. If you hold on, the market might turn around and take it all away. If you click the close button right now, you win. You get to feel smart. You get absolute certainty. So you click close. You take the $50. You smile. Mathematically, you just signed your own death warrant. Trading is a massive numbers game, based entirely on risk to reward. If your system is built to risk $30 to make $100, you only need to win about 30% of your trades to break even. But if you panic and continually close those trades at $50, you have completely ruined the mathematical architecture of your system. Now you have to win significantly more often just to survive the week. You took the profit early because you wanted a biological dopamine hit today. But you are starving your account of the capital it desperately needs to cover the inevitable string of losses coming next week. You need those big $100 wins to pay for the $30 losses. If you chop the head off your winners the second you feel uncomfortable, the math completely collapses. You traded your long-term statistical edge for 15 minutes of emotional comfort. Would you rather be right 4 days a week and slowly bleed your account to zero, or be wrong 3 days a week and eventually become financially free? Getting to that point requires a bridge. You cannot outsmart millions of years of biological fear with a sticky note on your monitor that says, "Be disciplined." You will lose. What you actually need is an electronic cage. This is what the Alpha Equity Manager does. It essentially revokes your free will the moment you become emotional. If you tell the software your absolute maximum loss for the day is 2% and your account bleeds down to that exact number, the machine takes the wheel. It violently liquidates every open trade. It turns your buy and sell buttons into decorative gray pixels. You are done. Of course, your heart will be pounding. You will go into the settings, hands shaking, trying to bump that daily limit up to 3% just to take one more revenge trade. The software anticipates your mental breakdown. It actively rejects your keyboard inputs and permanently locks your rules in place. You cannot negotiate with it. It even forces you to stare at the exact, brutal dollar amount you are risking before you are allowed to enter a position, preventing you from making confident mathematical disasters. The link for the Alpha Equity Manager is in the description. Outsource your discipline to a cold, unfeeling algorithm. Your biology is currently a liability. So, how do we actually trade if our biology demands a certainty that the market simply refuses to give us? You stop trying to control the wrong thing. Right now, you are obsessed with the micro. You want certainty on this specific trade. You want this one entry to be perfect. You want this one position to hit the target immediately. You are trying to predict the exact outcome of a single roll of the dice. That is entirely impossible. The more you try to control the outcome of an individual trade, the less control you have over your long-term equity curve. By choking your stops and cutting your winners to force a single win today, you destroy the math of the entire system tomorrow. True control in trading only comes when you surrender entirely to the randomness of the micro. You have to accept that you have absolutely no idea what the next trade will do. It might win, it might lose. The market might suddenly crash because a politician tweeted something stupid halfway across the world. You cannot control it, and you must stop trying. When you truly let go of the need to win this specific trade, you finally unlock certainty in the macro. The law of large numbers takes over. If your strategy has an edge, and you execute it 1,000 times without letting your fear ruin the math, you will make money. The outcome of trade number 7 does not matter. The outcome of trade number 40 does not matter. Stop trying to guess the next card. Just play the house odds.